It's a Monday morning, right? You wake up, you check your account, and through the glare of the screen, you can only see the color red, right? And in fact, all 3 trades that you had made yesterday was down along with the entire market. So it takes that you realize that you did not size your account properly, and hence you might have blown another account. Meanwhile, your trader John, right, your trader buddy, right, some friend you have that you always talk stocks and investing with, is probably making massive gains with his energy stocks, right, and huge juicy gains in fact, and he's probably going to be bragging about it over lunch. So today let's talk about some of the lessons and principles from a real life trader John, right? His name is Dury, right? Dury, and he has made it big during trend trading, right? And this is the guy right here, right? Dury Bernard Dury. He's a total trend trader, okay, and he has made big money on trend trading. And here are some of the lessons that he have given us, and I have learned from him as well. And I do wish many more people have known this as well. Alright, so let's talk about some of the lessons and principles that we have and what I have used to apply to my own trading over the years that made me more disciplined, less emotional in making my trades, and whether it improved my edge or not, I haven't calculated it yet, but it definitely made me more confident and being able to execute better on all my trades. Right, so I would say psychologically that made a huge impact on my trading. Right, so a little bit more about me. I'm a former financial advisor and I'm now in real estate, and in hopes that writing this article here on my Substack and now talking about it in my YouTube channel, The Stock Estate, right, it will help you capture bigger profits as well as, risk manage better, right, and some techniques that you have never heard of before or less heard of before that Dury talks about. So I'm going to go through 4 of the most important tips, alright, and that's not really mentioned by many of the trading teachers, and let's get into the video, right? So first one, let's talk about the first tip, which is when we are on a losing streak, right? First, we must remember to position size our account, right, or a trade based on our daily account value, right? And when your account size drops, right, daily, unrealized or not, your position size will decrease accordingly. Alright, this is a thing that's not really being talked about a lot, mainly because most of the advice that these trading teachers and people on the internet they tell you, right, is that size it so that you do not lose 1% of your account. That is counted a little bit more in depth, but not super in depth as well, because you see, when you only trade 1% of your account, right? What if your entire account drops by maybe 30% due to a market correction? So your 1%, does it reflect, the old value, right? The old $100,000 account that you originally had? Or should you trade 1% based on, after the correction, the 30% correction, your account size is now worth $70,000, right? You should only trade 1% of the $70,000 account. So this is very important because it helps you not blow your accounts, because if you only can lose 1% of the current value, right, it will take many multiple percentage losses, right, for you to, eventually blow that account. Okay, most people blow their account because they oversize too much, right? On a $100,000 account, they risk maybe $30,000. Okay, maybe based on future values or whatever, but because their account size shrank, but they still are trading the same amount, and that's how you blow, one of the accounts. So second tip that he gives, right, is make decisions on which sector of the market that you want to be in and which ones you want to stay far away. Cyclicals especially, can do very well told by Peter Lynch, right? Then they could turn tide really quickly. What do I mean by that? All right, let's take a look at the market trends, right? So you look at the U.S. industries, right, or U.S. consumer discretionary staples, energy, different sectors. Okay, you can see that right now, okay, consumer staples boom to the moon, very strong, alright? So you might want to trade this as a trend following trader, right? Whereas energy stocks are seems like on a downtrend, right? Financials on a downtrend. So if you seem that, this is the sector that you do not want to be in, right? Don't trade these sectors that you are not confident in, right? And instead, trade sectors as a trend following trader, right? You want to trade high flying trends, very strong trends that are on the upside, because most of the time probably a strong trend is backed up by some kind of fundamentals from a longer perspective, but also from a short-term perspective as well. So you want to trade those on a uptrend, right? A very strong trend, all right? And decide on which sector you do not want to be in, all right? Too many traders that I know, they're like, I want this, I want that, not quite sure, they're not really having a clear decision on what they want to trade on. Okay, yes, so do know, okay, have a clear plan in mind which sectors you want to trade, which sectors you don't want to trade, and stay out of those sectors that you don't want to trade and go into those sectors that you want to trade and trade those different sectors over there. Alright, and that is the second tip that you have. Okay, and if you decide that, you know, the entire market's looking a little bit bearish and you don't go short, then stay out of the markets. Alright, you have to make that decision to stay out of the markets. Alright, it is a big mistake, you know, to stay invested all the time, because sometimes you might see, you know, you have some spare cash along the side, but you see the entire market's kind of going down, and you see some warning signs, right? But you just ignore it and just put your money back in because you want to make money, right? And that's not how it works, right? And I myself probably had lost a few, you know, couple $1,000 on that as well, because, you know, I have made these kind of mistakes. So it'll erode your gains if you are constantly being invested and you overtrade over the long term. Alright, and that's the second tip that Dury has for us. Alright, the third tip, alright, is that the position size needs to reflect the volatility of the market at that given point of time. Alright, and what does it mean by trading size reflect the volatility, right? So there are different stages on the market where the markets are trending very high, very volatile. Alright, in fact, right, if you compare this to 2018, right now 2021 and 2020 is one of the most volatile periods of the stock market, right? Huge moves can be made. As in fact, yesterday, right, the last day of December, right, of 2021, right, suddenly, alright, huge rallies in a lot of the small caps, right, a lot of the undervalued growth sectors that boom to the upside, right? 8%, 10%, 15%, and it can downtrend for 5% losses every single day. So again, if you look at a certain security that you want to trade in, and that certain security, maybe it moves on average, right, 4% every single, you know, day, okay, and you can use it, you can track this by going to Finviz, or you can go to, just have a quick Google search, for example, maybe TIGR, alright, or Facebook, right? Average volatility in a day, right? They'll tell you like maybe it fluctuates average for the last 21 days, right? 5%, 10%. So again, if you know that it will move up 5% or 10% if it's a very volatile company, then you want to size it down accordingly as well. Alright, so you can develop your own formula for that. I have my own formula for that. So you have to find a formula that is more comfortable for you. But the general principle is the more volatile that stock is, right, the position size, you gotta size it a little bit lesser, because it's easier, you know, to take a huge stop loss on that certain security. Alright, let's go on to the fourth point over here. The fourth point over here is that, you know, hey, your trading and investment portfolio needs to be diversified, right? And preferably in sectors with low correlation. Okay, exit the failures, and there will definitely be failures, and write the winners. Okay, what does it mean by this, right? So the trading and investment portfolio, you need to be diversified, alright? Do not all just trade maybe, you know, this auto industry, or you just trade the home building industry, or you just trade the, you know, just the tech industry, right? Because if you have all four trades on the tech industry, right, and if that week, the sector is bad, right, bam, every single one of them would go to the downside, right? And it is a huge, massive L for all four of them. But if you diversify, right, and on sectors that have low correlation, for example, consumer staples or healthcare versus technology, right? Okay, more often than not, okay, when one sector goes up, one sector will go down, okay, and you will probably make an L on one, alright, and make a win on another one. And your L probably might be a smaller L because you have picked certain securities that are very, very good in that certain sector, which might not take a huge dump, alright, and overall it will improve your win rate, alright, and in a sense it helps you psychologically, at least for me, in fact, alright, that, you know, you are not taking L's all the time, like all the trades are gone in one certain week, right? You always have some winners, some losers, so in the end you are able to equalize it, alright, because the main thing right here, you know, is to not lose money, because once you start losing a lot of money, a lot of the time, maybe a couple of weeks at a time, that's when you start to lose confidence, and a lot of the traders will drop out of the game and be just be long-term investors, or just backhold their companies, and that's not what we want as trend following traders, right? And that's it, that, you know, that's it. If you have, you know, investing or trading in different sectors, right, there'll definitely be failures. Okay, because example, if you trade in just technology sector, right, okay, it's just like 50-50 flip, right? So 50% if it goes up, alright, then all four will be good, alright. If it goes down, all four of them will be bad. But if you are diversified in two sectors, right, more often than not, one will be good, one will be not very good. And you must exit out of the one that you feel that is a little bit more shaky, reinvest those profits in the trend that is going strong. So again, you are trying to capture the trend, the big move, right? Take a small paper cut on the sector that is not currently performing well, and move it to the sector that is going very, very well. Alright, and that's the essentials of trend following strategy by Dury. Alright, and a lot of trend traders, they use this strategy for the upside. Alright, okay, and that's about it for the 4 big tips that I have for you, alright, and that I learned from Dury, and that I think there's massive potential for you guys to learn from and apply to your own trading strategy, alright, whether you're a trend following trader or not. Alright, this applies to even long-term investments, right? You want to be diversified, don't want to put all your eggs in one basket, alright. For the less risk adverse investor, it's definitely very, very useful for you guys as well. Alright, so let me end off with saying this, alright, I'm quoting myself over here because I do have a lot of insights when I'm writing these kind of articles, alright, is that we can apply trend trading, to our own lives as well, right? In life, there's always risks, and when we take a risk to go for, one career or something that we want, alright, go for it, aim high, write it out, right? Follow the trend, right? If everything's going well, you want to go for the highest position in that career that you want to do, your dream job, don't settle for less, right? But you must always, at any given point in time, know what you're risking, right? To get that dream job or get dream thing that you want to do, or the dream amount of car, your house, or whatever, right? You must know what you're risking, right? If you're risking too much, right, then, it's not a really wise idea. And if you are risking and you know what you're risking to get to that point, alright, and you start to feel that, hey, I'm actually losing a lot of money to start this business, alright, know when to take an L, alright, exit out of this, don't get wiped out, alright, and you can start anew on something new and that's better suited for you, alright. Too many people I know personally, right, example here, he's going for a food business, right, and they just pour all their life savings into that, right. When the business not running well, they say, I'm gonna write it out, I'm gonna close my eyes and grit it out, right, until all their savings is just poof, gone. Then they just fell into depression, they just didn't want to start up everything again, and they felt that life is unfair and everything, when they should have just cut their losses, maybe when they felt that the business was not doing very well, alright, and take the rest of the capital, move on to something else, and he could have a totally different life if he did so. And yeah, so that's about it for today's video, okay? I hope you guys enjoyed today's video, right? You can subscribe to my Substack over here, right, yotongbun@substack.com. Alright, go subscribe to my newsletter. I have the written form over here where I do my videos on. So again, if you want a recap or a quick TLDR, you can go back here to, read through, alright? And you can join our YouTube channel, the stock community of over 1.5k members, alright? And go to the YouTube channel, Stock Estate, alright? And which you're watching this video from. And drop a like, drop a subscribe, and I shall see you again in the next video, everyone, alright? Stock Estate out.